Hey everyone, Douglas here. Welcome back to the MMT Macro Trader. It's market recap time for Tuesday, September 19th, 2023. And look, we have some very important things to cover tonight. I don't mean to be hyperbolic here, but the risk of recession, the risk of ruin, the risk of market calamity is as high as it has been in quite some time. Certainly for the extent of 2023, probably going back to the COVID sell-off, is as risky of a situation as we have seen in markets. And it all has to do with the potential of a government shutdown, and not just the potential of a government shutdown, but the timing that the government shutdown might take place. So that's what we're going to look at tonight. I'm going to explain what to keep an eye on with regards to the looming government shutdown, the headlines that we're seeing. And then I also put together some seasonality data to hopefully show and demonstrate why this September into October timeframe is kind of loose ground. It's kind of thin ice to be traversing, and a government shutdown can just exacerbate what it is that we're already seeing, which is some selling as we finished off last week and as we've kicked off this week. Very weak markets, of course. I've been very vocal that I've been on the sidelines here as we head into September and October. We've been expecting some weaker than normal flows during this time frame. We had a big tax drain on Friday. We're likely going to get another big tax drain in October. Already, like I said, a very brittle market. And now with a looming government shutdown and the odds of that government shutdown increasing, the possibility for things to get very out of hand, for selling to get very out of hand is very, very real here. So that's what we're going to discuss tonight. Listen, as you can hear, my voice, I'm completely losing it. Bear with me. My proverbial voice has never been stronger, and what I got to get across tonight is very important. If you're new here, make sure you get subscribed, hit that notification bell. Hit the like button as well if you find this helpful. But other than that, let's go ahead and get underway. You can see the betting odds for a government shutdown has accelerated over the last 24 plus hours here into above a 50% chance. Now look, God only knows exactly how these betting odds get determined, but clearly, I understand how they get determined, but God only knows who's actually betting on these, how reliable these betting odds actually are. But suffice to say, it's very clear that there is a non-zero chance right now of a government shutdown, and you only have to look at the headlines to see the risk that is currently out there. You got the GOP unwilling to come to any sort of consensus. The hardliners are really pushing back here. The headlines are painting a very clear picture that once again we're going to be playing chicken with a deadline. In June it was the debt ceiling deadline. Now it's going to be the government spending deadline. The good news out of this, unlike the debt ceiling in June, the good news now is that there is still mandatory spending, non-discretionary spending that will still take place. When you hit the debt ceiling, that is a very quick spiral to zero. Spending will still take place. A lot of the non-discretionary spending continues to take place. With that being said, if the shutdown is, let's just say, a weekend, a week, that sort of thing, relatively short, it's not going to affect the underlying structural flows all that much. But if that shutdown looks like it's going to be extended more than a week, let's say maybe a couple weeks, let's say maybe a month, you will see deep structural damage done to the underlying flows. But even before that, what will take place is essentially the fear hedge, right? Market participants are going to say, I don't want exposure to the unknown, to the uncertain. I'm going to open up protective puts, some sort of hedging activity, to where if things get really out of hand, if the selling really kicks in, that they're going to get essentially hedged to that, so the damage is relatively muted. Of course, what we know is that when that hedging activity takes place, it's a bit of a self-fulfilling prophecy. Market makers, when they open up those puts, when they are on the opposite side of that contract, they have to sell to hedge their delta risk. So they are selling into those puts being open. So if those puts start to accumulate, that only adds to downward pressure on the markets. You add add to that then the government actually shutting down, deteriorating flows, and we could really see things get out of hand as we head into October. Like I said, look, I've been on the sidelines for effectively a couple weeks now, heading into what was going to be a time frame when we were expecting a bit of a reset in markets. I'm not looking to short this market, but the risk is certainly there for some massive selling if the government does end up shutting down. And then not only, again, will you start off with the essentially we'll call it the fear selling, it can then start to do damage if the government shutdown continues on to the real structural underlying flows longer term, depending on how long that government shutdown goes. Now, look, any spending that doesn't take place because of a government shutdown, most of that will be back paid. Eventually, it'll be caught back up. But if there's an extended shutdown, weeks, maybe into months, that's going to have issues. Now, one of the other things that won't shut down is the IRS. Taxes will still be due. The IRS will still collect those taxes. So you will have the tax drain constantly there without the flows coming in behind. So again, the sequence is going to be, if we end up getting a government shutdown, it's going to be the fear trade. The fear trade then will give way to actual structural flow damage, and that could then in turn put us into a recessionary environment. So that's what we have to watch out for. That would be down the line, then. They would be certainly looking down to the end of October, possibly into November, if there still is a government shutdown at this point. All right. At the outset, I said I had some data that I wanted to show, seasonality data, and I'm going to go ahead and pull that up. What I did, going all the way back to 1982 today, is I averaged the average return for each day of the calendar year. So every single day, 1980 to today. Find the return for each day, average that out over that 43-year period. And what I just really want to point out here is the fact that, we are in mid-September and you start to see a lot of volatility in both directions, both higher and lower, as we enter this time frame. And it's because one of the largest tax drains occurs in September and then October, year in and year out. And that's why the highest risk consistently shows up in that September to October timeframe. Now, again, it is volatility in both directions, though, right? Because usually by the end of October, as those big sell-offs are occurring, you're going to get big bounces to the opposite direction, and that's exactly what we see play out. So the thing here is that from a seasonality standpoint, we are at the riskiest part of the calendar year. If I take these returns and I go ahead and create a kind of a hypothetical account here to show the percent return, what that would look like invested over the historical year, over the historical average. And then what you can see is that time frame in September and October that we were just looking at is the time frame where we get the deepest drawdown and the longest sort of sideways action in the historical year, in the seasonality, right? So if you figure already this is where the choppiest returns take place, and then you add the fact that these core structural flow might completely give way or start to give way because of a government shutdown. And then on top of that, you add a fear trade where you can get some reinforced selling to take place. It is a recipe for disaster. Again, a lot of this is going to be dependent on the Congress and the Republicans effectively coming to some sort of agreement. This could all be resolved as we head into October. Maybe we get a government shutdown just for a couple days just to prove a point, and then things get resolved. A lot of possibilities to play out here, but the thing I'm trying to drive home is that it's going to take place at a point in the kind of cyclicality of the flows where the highest risk of drawdown is at. So a lot of risk in the markets right now, and if we see an extended sell-off here, if we see an extended shutdown, we can expect an extended sell-off here in markets given where we are at. All right, I made it through. I think my voice is done. I'm going to go ahead and wrap things up. But before I do, check us out over on the Patreon page if you like this sort of research, this sort of analysis. Patreon.com/MMT Macro Trader. Link in the description below. Listen, we are absolutely crushing it this year. And if you're just interested in the track record, interested in terms of where and what we've been calling over the year, Also, check me out on my Twitter page. I post, kind of my bigger calls there, the bigger thematic ideas get posted over there. Certainly the video updates here as well. So if you're looking for that, you can find me over on Twitter. All right. That's all I've got for tonight. Until next time, everyone, good trading, and we'll talk to you next time. Bye-bye.